Welcome to my channel, Motivation and Finance. Many mistakes, especially in your 20s, are inevitable. But the sooner you figure it out how to take care of your finance in some basic ways, the better off you will be. If you want to master your mind, check out these bad money habits that make me broke at age Number 1. No financial advisor. I started earning money at age 22. There was no curriculum in school or college that teaches money habits, difference between assets and liabilities. In 20s, since I started earning, it was very difficult to control myself to save and invest the money in assets. Now I realize that if I had invested in 20s, then I would have built my wealth at 30s or 40s. Number 2, waiting until you have more money to invest. Time is on your side when it comes to investing thanks to the power of compound. Contrary to popular belief, you don't need to be a personal finance expert or even earn a massive paychecks to get started. At age 20s, I was having more money to invest, but unfortunately, plan for investment ended up in expenditures or liabilities. Unfortunately, incident happened to me. There was a scheme by government to reduce tax to invest in mutual fund. I was forced to invest my money, but later after 5 years gave me a lot of dividends and takeaway. Don't wait. Even if you can't invest a ton of money, establish the habit of setting aside at least a little bit each month. Whenever you get a pay bump or bonus, reevaluate how much money you can realistically save. Number 3, the most important things: credit card and making late payments. At my 20s, getting credit card made me the worst financial decision in my life. In addition to costing you money in fees, missing payments can lower your credit score, which affects your ability to borrow like home or car in the near future. Never miss a bill again by setting up automatic payment online for fixed costs such as cable, internet, and insurance. For expenses that can't be paid online, such as rent, setting up calendar reminders and pay them at the same time each month so it becomes spending all paychecks. If you are spending as much as more than you are earning, you are living paychecks to paycheck, which can easily spiral into credit card debt. That lifestyle makes it nearly impossible to build up significant savings. The solution: live below your means, not at all. Number 5, no savings goals. Money won't just appear. If you want to save more, you have to have a clear goal and then set a specific plan in order to start by determining exactly what major purchases you hope will be in your future, like a home, car, or education for your kids. Next, determine how much you need to save for them and for how long. Finally, setting up a recurring automatic transfer from your bank account to all your savings account to ensure you will stay consistent. Number 6, paying 1% to 3% of your credit card balance. Most credit cards only require you to pay 1 to 3% of your balance each month. Paying the minimum can be tempting options, especially if your budget is tight, but it can cost you a fortune in the long run because you'll have to pay interest on the outstanding balance too. Get in the habit of making payments in full. The easiest way to do that: arrange to transfer the full amount of money you owe from your checking account to your credit card. Find yourself overcharging consistently and struggling to pay more than the minimum. Try ditching your plastics for a while and going on a cash. No control over the money in spending, whether it is calling a taxi instead of train or bus, stopping by the beach around the corner every morning, or picking up a mojito while waiting in the checkout line. It's all too easy to spend mindlessly. Try tracking your expenses to get a better idea of where you spend your money and where you can cut back. Don't stop there. Do something with that extra cash, such as putting in the retirement account or savings account so it can grow over time. The solution: keep Excel sheet with pie chart that shows the savings and expenditure. No savings, no retirement savings accounts in 20s age group, no emergency fund scheme adopted. In general, if I had lost job at age 28, was broke with no money and higher debts, keeping your hands off it. What I learned: to create a mental and logistical barrier between you and this money, move it into a separate account such as high interest savings account or money market account, which both offer higher interest rates than traditional savings. Ignoring insurance. When I was young, it's easy to think I was invisible and forego insurance to save a bit of money each year. But even one accident can wipe out of my savings. Insurance policies are largely personal. To get the best coverage situation, educate yourself by shopping around and getting multiple quotes, reading your policy closely before signing on, and asking questions when you don't understand. High interest debt is not prioritized. Credit card, personal loan, home loan at age 28. What a terrible financial imbalance I made after 6 years of job. All debit is not created equal. An effective strategy is to rank your obligations in order of interest rate from highest to lowest. Then prioritize the debt with the highest interest rate while still paying the minimum on all of them in order to pay less over the long. Alternate options too. Rank your debt in order of size. Start with the smallest. It's a strategy that most personal finance calls a snowball method. The idea is that each time you pay off one form of debt, you build momentum which helps you tackle the next biggest, and so on. What I learned, if you can't control your finance, don't go for credit card, personal loan, home loan, or any other forms of loan until you realize the difference between the bad and the good debt. Show up your friends. Living up to your friends or co-workers standards is tempting if you are guilty of it, if you are not alone. More than 75% of 22 to 30 years old use their friends' financial habits to determine their own. That being said, choosing where to eat, what to wear, and what gadgets to buy based on what your friends do can wreck your budget. Just because your friend seems able to afford the latest Apple products or an all-inclusive trip to the nice vacation spots doesn't necessarily mean to a blind eye. As much as you want to ignore financial red flags, you are better off dealing with any issue. Check your bank account and credit score, no matter how low the fear the number may be. Don't leave your debt for tomorrow and take advantage of work perks and benefits which could save you thousands of dollars a year. Remember, you are still young. You don't need to have all this perfect yet, but ridding yourselves of bad habits now will pay dividends for the rest of your life. Thank you.